Hello, everyone, and welcome back to another episode. I'm your host, the Millennial Investor, and today we're going over a company called 3M. If you know me and my portfolios, which is disclosed right here, my portfolio values that I update every single month, as well as my portfolio performance for the year, as well as, of course, my total balance, which is right here, just under $40,000. We have two portfolios that I like to track in M1 Finance that I share down below in the description. One of those is, of course, my dividend growth portfolio. The other one is the growth portfolio with just two small holdings in it, these two, Amazon and Salesforce. But as of the dividend growth portfolio, we have a core holding of about 5% that have been in here since I started the portfolio back in April of 2020 on this little bitty line right here, years ago. It's crazy to think how long we've been doing this channel. But anyways, one of my core holdings has been 3M, and throughout the past couple of years, this company has just been down and out in a big way. Despite the big bull market that we had in 2020, 2021, and even starting into 2022 before the big recession happened, this company has went down and down and down and down, and today's price currently sitting right at about $130 per share. So we're going to talk in this video why I still own this company, even the dividend growth portfolio, why I continue to have it as a holding. We're going to talk about the overall business of 3M, where I think they're going, some of the good, some of the bad about this company, because there's also a lot of good and a lot of bad, and this is a company that I'm always torn on. It's not a company that I'm ever excited to just say, oh, I got to add more, it's the best company ever, but it's also not a company that I'm just like, oh, got to get rid of it, it's the worst, because it's kind of double-sided. So we'll show in this video all my reasons is behind that, some of the main bullet points that I think you need to know about. But without further ado, let's go ahead and jump into 3M and get started for why I think this company is kind of an in-between. It's a hold. It's not a buy or sell for me. So let's go ahead and get started. Before we do that, go ahead and check out the stuff down below in the description where you can get up to $200 for certain credit card referrals, as well as $10 for getting signed up with this brokerage right here that we've been showcasing, which is M1 Finance. You would be helping me, you would support the channel, and you get $10 for doing so. Thank you for checking that out. And 3M. This company has many different segments. It is a big conglomerate, and they sell a million, bajillion, trillion products. And if you don't believe me, let me go ahead and give you an idea what I'm talking about. If I go over here and I go to all 3M products, now these are just some of the categories that it highlights. Now I'm going to set my little auto scroll on here, and while I'm talking, you can be seeing some of these products that I'm talking about. They are extremely random. I mean, from all different types of random stuff to sealants, to tape, to post-it notes, to cloth, to like a surgical clipper I just saw right there, pads, washing equipment. I mean, it's all random stuff that everybody needs but nobody thinks about. So it's hard to really put 3M into one category or one specific thing. Normally when you think of a business, you normally can associate really quickly what that business does, but 3M has tens of thousands of products that are all in different types of scenarios and different types of business and industries. And so when you try to get a gauge on what 3M actually does, sometimes it's really hard to gauge that because they kind of do a little bit of everything. And this makes modeling out their growth, modeling out their profitability a lot more difficult than a traditional business. And once again, I'm just scrolling through here. This goes on, if I were to leave this on auto scroll, we would literally have this YouTube video going on for an hour. So I'll go ahead and stop it right here. You get the point, but you see what I'm talking about. This company produces all types of random products, right? And so this is what is the good and the bad news. The good news is that with them having so many different categories, being in so many different areas of the economy, is that it does make them much more defensive. If one segment of their business goes plummets, right? So let's say, for example, in their safety and industrial, okay? Let's say that the closure and masking systems went down, went into the toilet. That's 9% of one category, which is just this teeny tiny little pie of these tens of billions of dollars that this company produced, which last year was $35.36 billion. That little segment right there, if we do 9% of that, what is that? That's about $1 billion. So them losing $1 billion out of 36 would suck, and that would assume that one little business would go to zero. But going from 35 billion down to 34 billion is not a huge deal. The company's still doing fine. And that's what I'm talking about. Between their safety and industrial, their transportation and electrics, their healthcare, and their consumer business, all these different categories make up for a giant conglomerate, which is why they have all these different products. Now, the flaw of that, the problem of them being so big and being around for so long is that the growth is starting to slow. And you can see this highlighted from some of their quarterly highlights. Now, as usual, I like to just give a lot of information, and if you want to pause the video and read over this, I won't go line by line, but some of the main bullet points is this company grew organically at about 1%. 1% growth. Meanwhile, inflation is running at basically double digits. You have this company only growing 1%, and its operating margin isn't really improving all that much either. Its earnings per share is not really growing at a really fast pace. And you can see this if we hop over to Qualtrim and look at this on a quarterly basis, including this quarter being at an awful one-time hiccup due to some lawsuit issues. But you can see the earnings per share and the net income is pretty much stagnant. Look at the net income here, because that doesn't factor in all the share buybacks. You can see this become more apparent ever since since the end of the Great Recession in 2010. It's slightly trickled up, but hasn't really went that much higher in a big way. And the same thing for the free cash flow. And the revenue, it's a slow trick up, and I feel like this is mostly even due to inflation, not even so much of the business actually growing, coming out with new products, coming up with new innovative ways to grow the business. And you can see this even follows suit with what analysts believe. Analysts believe that this company is only going to grow top-line revenues negative this year at 1%, plus 3% next year, plus 3% the following year. Very, very slow growth. They do think that earnings will come back a little bit, but a bunch of this is due to share buybacks. And this leads me to the main issue with 3M. When I look over their investor relations, okay, you can go through all these tabs, you can read earnings reports, you can read the company CEO statements, you can look into all this stuff. And I try to find, like, for example, this. They have this big 94-page presentation on how the business is doing, is what they're planning on doing moving forward. And I got to be honest, even this company doesn't do a good job of lining out a clear path of how they're going to grow, right? Let me give you an example of what I'm talking about. This is a company that I own, which is ticker symbol CRM or Salesforce. This company is growing quarter after quarter, record after record, and is because of its subscription model. Now, this company has a huge moat. It builds entire businesses off of its platform, and then if it wants to ever raise prices in the future, it can do so because it has such a strong moat and customers are not forced to leave. Furthermore, they're in a growing category, a growing industry, and that's what causes this revenue chart every single quarter to go higher and higher and higher. And if you look at this annual free cash flow, you can see it just starts to get ridiculous when you see that the free cash flow is growing 15, 20, 30% sometimes in a year, and it's just pretty much going in a straight line up. I can make the growth path for this company with my own eyes. I can see it very clearly, right? And then a company like Amazon, my other investment, one of the main reasons why I own this company is because of AWS, because the growth path is very clear, very easy for me to see. When I pull up a company like 3M, it is much harder for me to imagine the reason why this company would be growing 5-10% a year for the next several years. When you look at this chart, it's not as sexy. It's not as pretty looking, and it's pretty much just flat. Very slight growth over the next couple of years. And this company doesn't do a very good job of aligning its growth path out either. Now, the one benefit to this company is that they return shareholder money in a massive way. If we go back over to the 3M chart here and we pull up the dividend continues to grow year after year after year, going back to, let's say, 1970, paying out 3 pennies per share. It goes up and up and up, year after year after year, slightly trickling up. And then today's payout price from 3 cents decades ago, now paying out about $1.50. That is a massive uproar. That's 50x in 50 years, so not so bad. The good news is, too, beyond this, is that the shares outstanding. Look at this, quarter after quarter, going back to 1985. Down, down, down. So if you own 100 shares of this company, you will have a higher and higher ownership percentage. And of course, this makes their earnings per share go up over time, which is part of the reason why I said their earnings per share chart looks slightly better than their net income chart that's a little bit more flat. So that's the good news, is that you're getting a lot of money returned to shareholders. The bad news is that they're putting so much money back to the shareholders to keep them invested, is that now you can't really grow the company. So to reiterate and just to summarize, this company pays out a massive dividend yield, 4.5%. You're going to get a lot of money, you're going to get a lot of dividends, you're going to get a lot of share buybacks, and a lot of money returned to shareholders. But the only way that this company really grows is if the overall economy grows. And in times like now, we're in a recession, you're not going to see much growth, even when this company's in a bull market and the recession stopped and the economy's going great. I think you're still going to see this company struggle. But regardless, it's one that I think is not a bad hold due to the free cash flow that this company produces and the wide economic defensiveness that this company has. It's not a bad hold. But then again, it's not a bad buy either. It's not a bad sell. I'm just kind of in between on it. So overall, I hope that gave you some more insight. Hopefully you have a little bit more reasons and to look into 3M, and maybe if you can figure out a little bit more about this growth path than I can, I would love to hear it down below in the comments. Thank you guys so much for watching. Check out all the stuff down below in the description, and I'll catch you guys next time.